Yachts and boats, commercial marine, high-performance boats. Yep, we've gone boating. Arrowhead Marine Insurance, available coast to coast.
Director and officers' liability coverage continues to evolve. Susanne Murray, an Executive Vice President for Alliant Insurance Services, knows all about this evolution and her work focusing on executive risk liability exposures. In this interview with Insurance Journal's Andy Simpson at the recent Professional Liability Underwriting Society's D&O conference, Murray discusses this evolution of D&O, beginning with how policies are responding to investigations, formal and informal, third-party, and internal.
It all goes to the definition of claim, what is covered by the policy. And so, there are various elements, the most obvious of which is a lawsuit. The question becomes, when it's not a lawsuit, what else is covered? And one of the standards that have been covered under the D&O policy has been formal investigations involving insured persons. So, for example, a formal investigation would be a proceeding brought by the Securities and Exchange Commission, as an example, against an individual alleging wrongdoing. It's a formal investigation with a notice of charges as to what you did wrong. Investigations coverage. So then the question has become, and the evolution of that coverage has been, what about when it's not yet a formal investigation? So we don't yet have a charge, or we don't yet have specific allegations of wrongdoing. How can we get that covered? And so one of the things that the policy has been moved or evolved into is coverage for formal and informal investigations involving insured persons. Frankly, the idea is if an individual is hiring counsel to respond to an external investigation or inquiry, for that matter, should be covered by the policy, especially if the individual has to pay for it themselves. So first step was informal investigations of individuals. And this was defined, the word informal would be used, but in addition, maybe after they're identified as a target of the investigation, or after they've received a subpoena to produce documents and to give testimony. So that's the evolution. So then the next step is, it's an inquiry, but we haven't subpoenaed you. We haven't identified you as a target. We haven't in any way suggested at this point that you've done any wrongdoing. But we want you to voluntarily come in and talk to us about something. Is that a claim? Historically, no. So next step in the evolution of the degree to which investigations are covered is that. It's an inquiry. It's not a claim. You haven't yet been alleged to have done anything wrong, but you've incurred cost. We'd like you to cooperate voluntarily, and you do so. So that's kind of been the evolution of investigations by third parties into a company or its insured persons. So in the compendium, you've now gotten to that point, which is investigations that are not initiated by third parties. And the first type of coverage that we had for what you could call internal investigations was for something called shareholder derivative demands. And specifically, a shareholder derivative demand is a letter from a shareholder, usually addressed to the company itself, maybe to the board of directors, which alleges wrongdoing. For example, there's wrongdoing in the finance department. It could be broad, it could be very specific, but nonetheless alleges some sort of wrongdoing. And it indicates that I am demanding that the company investigate these allegations and, if appropriate, bring the claim. So I want the company to bring this claim against the wrongdoers, which could be the people in the finance department or the entire board of directors. That's a shareholder derivative demand. As a response to that, the company is supposed to conduct an investigation, determine whether or not the allegations are true. The investigation is to determine whether or not the allegations are true. So therefore, whether or not to prosecute a claim, whether or not to bring the claim, not respond to a third-party investigation, actually conduct your own investigation with an eye toward possibly being the plaintiff, not the defendant. So that's a big change from a D&O perspective. The way that that coverage has been given has been very narrowly, which is you have to go hire outside counsel or create a committee to do this investigation. So we're going to pay for it, for the investigation itself, $1, no retention, with a sublimit, which means we're only going to pay up to a certain amount. But if you bring the claim, then you're not getting any more coverage there. This is solely for the cost of the investigation itself. And if a third party, like that shareholder who made the demand, brings a claim, the costs that you incurred here don't count in connection with that claim. So the idea of internal investigations coverage began with shareholder derivative demands, but it has actually broadened to, for example, whistleblower claims under the Dodd-Frank Act or otherwise. Whistleblower claims are claims internally or allegations from an internal source. They're people who are going to blow the whistle on some impropriety within the company. So they're insiders blowing the whistle. And there has been whistleblower protections under the law previously. But what the new Dodd-Frank Act did was it provided additional significant incentives for an individual to be a whistleblower. Financial incentives. You get a big piece of the pot, for example, if we bring a claim and there's a financial resolution. So well worth it, particularly for employees that are disgruntled. A good idea to figure out something that they can allegedly blow the whistle on. And Dodd-Frank encourages that. So there's another example. I've got a whistleblower allegation. I need to do something about it. I need to do some kind of investigation to determine whether or not there's any merit to these allegations.